silent financial monster is waking up in Asia, and it could sink the entire global financial system. Japanese government bond yields are surging at a speed not seen in decades, and analysts are now warning that what's unfolding in Japan may trigger a worldwide financial shock. For nearly 30 years, Japan has lived under ultra-low interest rates. It became the foundation of global cheap money, fueling everything from Wall Street stocks to crypto, real estate, and emerging markets. Trillions of dollars flowed through the world thanks to the yen carry trade. Borrow cheaply in Japan, invest everywhere else. That foundation is now cracking. Japan's 10-year bond yield has exploded to multi-year highs. Long-term yields are spiking violently. And suddenly, the world's most stable bond market is becoming the world's most dangerous pressure point. This isn't just a Japan problem. This is a global system risk. For decades, Japan was the world's largest exporter of capital. Its pension funds, insurers, and banks bought U.S. treasuries, global stocks, emerging market bonds, real estate, and private credit. That flood of money helped keep global interest rates low and asset prices high. Now the flow may be reversing. As Japanese yields rise, investors no longer need to chase risk abroad. Money can rush back home. And if that happens on a large scale, global markets could face a liquidity vacuum, the most dangerous condition in finance. Hedge funds are already unwinding carry trades. Currency markets are flashing warning signals. Bond markets are becoming unstable. And risk assets, stocks, crypto, high-growth tech are starting to feel the tremors. Analysts warn of a terrifying chain reaction. Rising Japanese yields pull capital out of global markets. Global bond yields jump. Borrowing costs explode. Debt markets seize up. Highly leveraged players begin to fail risk assets. Collapse, credit freezes. A full-blown financial crisis ignites. One strategist put it bluntly, if Japan breaks, the world breaks. What makes this moment especially dangerous is Japan's massive debt load. Its government debt is the largest in the developed world. Rising yields mean rising interest costs, and that puts enormous pressure on the entire Japanese financial system, including banks, insurers, and the government itself. If confidence in Japan's bond market cracks, it wouldn't just hit Asia. It would rip through global markets faster than any regional crisis in history. This is why some analysts are now openly using the words systemic risk. Japan is no longer the quiet anchor of global finance. It is becoming the spark near the fuel tank. And the worst part? Once a global bond unwind begins, it is almost impossible to stop without massive central bank intervention. For now, markets are holding their breath. But make no mistake, Japan as bond market is now the most dangerous place in global finance. This is a developing crisis,